Statistics Canada has just released the most recent labour force survey. In December, employment was little changed and the employment rate held steady at 60.9%. The unemployment rate rose 0.3 percentage points to 6.8% as more people searched for work. Here to unpack those numbers is Jimmy Jean, Vice President, Strategist, and Chief Economist at the Desjardins Group. Jimmy, thanks as always for joining us, and Happy New Year to you.
Happy New Year. Thanks for having me.
This number seems a little bit more in line after what we saw with November's numbers.
Yeah, well, I mean, it's coming in more subdued, definitely, but still above expectations here. Consensus expectations were for a very slight decline. So, and we managed to get a fourth consecutive month of gain. So that is positive, I would say. Of course, the flip side is that we see a pretty significant rise in the unemployment rate, but that comes after a pretty steep decline in the month of November. And the reason the unemployment rate goes up is because you have more people searching for jobs, so the participation rate goes up, and you also have an increase in the labor force. So it's not the sort of rise in the unemployment rate that is due to mass layoffs. So we're not seeing that in the numbers. It's more people that are looking for jobs. So I would say it's a satisfactory report overall, with the headline numbers. And it does suggest that through all the trade concerns and the uncertainty, the job market manages to stay quite resilient.
So do you think, I guess, because the jobs situation has managed to stay resilient and I guess surprised many people, right? Because we thought with regards to the tariffs that things would look a lot worse, and that worst case scenario never materialized. You think that's why the Bank of Canada was on hold this past, I guess, December? They cut rates in the U.S. Their jobs numbers obviously are also waning a little bit, but their growth numbers are better than ours. Their inflation is higher than ours, yet they still cut rates. What do you think these numbers mean for the Bank of Canada? I guess that's what it all comes down to. Do you think they're going to cut rates based on these numbers?
Yeah, and I think the Bank of Canada had a little bit of a lead compared to the Fed in 2025. So they had cut rates in advance. The Fed decided to resume its rate cut cycle later than the Bank of Canada. So interest rates in the U.S. are higher than they are in Canada. So from that standpoint, the Bank of Canada indeed felt it had the, I guess, luxury of time. You still had inflation above the target, slightly above the target. Of course, lots of distortion in the inflation numbers, and we're going to see that in the upcoming months. So I think the Bank of Canada just wants to wait to have clearer numbers on that front. But yeah, the job market resilience is certainly part of it. And I think today's numbers just reinforce the idea that there's no sense of panic here. So long as trade is not extremely damaging. We saw numbers yesterday that showed exports actually going up. We're seeing diversification as well. The exports to countries other than the U.S. are ramping up. Still a smaller share, of course, of total exports, but are ramping up very rapidly. And we know that the fiscal picture is very stimulative, is going to be very stimulative in 2026, particularly starting the second half of the year. So the Bank of Canada takes all this information in consideration, and we think it's still on hold. We think it's on hold for the remainder of the year, unless something very disruptive were to happen. Of course, we're going to be looking at the CUSMA revision talks very attentively. I think that is the major wild card right now. We abstract from all the geopolitical stuff going on right now, but otherwise, it's really the CUSMA revision process. But otherwise, with the information at hand, I don't think there's a compelling case to do anything at the next meeting.
Just want to bring it back to some of the numbers. The youth unemployment rate, we're just putting this one in here, 15 to 24, it rose 0.5% out to 13.3. We saw a decent drop in November. Any idea on why the swings?
Yeah, and we see in November we had seen a pretty big increase in part-time job creation, which tends to disproportionately be filled by youth, and now we see a little bit of a reversal there. This is what we said last time. We have to be careful in not overinterpreting the full-time, part-time distribution of job creation because it's very volatile, and that's what I think the drop in youth employment in the month of December reflects that. So I think we have to wait a few months to determine where the trend is. But certainly, I think the big picture, and even it was the case in November, despite that drop in the unemployment rate, it's still very tough out there for the new entrants to the labor market.
I guess for me, I know we talk about the numbers and everything, and I asked the question about Bank of Canada because I think that's what it all comes down to, right? Making things more affordable for Canadians, hopefully more jobs created, more money in the hands of Canadians. I know Premier Ford talked at a presser recently talking about cutting taxes, cutting interest rates. Now we're seeing jobs growth hanging in there. I guess, with our economy predicted to grow just over 1%, to me, I'm hopeful that the Bank of Canada would actually consider cutting rates at some point, even with some job creation, making things maybe a little bit better. I know that we're just we can afford to take a wait and see approach, but what happens if we actually were more proactive and we actually tried to do things to stimulate growth, to grow more jobs, to put more money in the hands of individuals? Do you think that would make sense, or do you think that would be inflationary, or would that be an issue?
I think that's the big issue, and the inflation crisis of 2022, 2023 is still very vivid in the minds of Bank of Canada officials, and they want to avoid being perceived as careless managers of that risk. So I think they manage that risk very attentively. It's true that at face value, Canada could benefit from support, but I think the approach has to come really from the government. Interest rates, they work to a certain extent, but we know that they have adverse consequences in terms of fueling real estate exuberance. We've seen that movie before, and certainly that's not the approach we're thinking right now is the right approach long term to support this economy. We need to see more investment. We need to see trade diversification. And really, the Bank of Canada interest rates only play a secondary role in boosting that. Okay. Having said that, you look at rates currently, they're not restrictive either. They're even very close to being stimulative. And the Bank of Canada has its door open. I mean, if the numbers of the economic numbers or inflation were to undershoot, they've been clear they'd be ready to give a little bit more. So I'm not too worried about that, but certainly I think the focus still needs to remain on government, and not just what they announced in the last budget, but also deregulation, boosting productivity, and that's there's been little on that, and we need to see that happen as well.
Okay, we have to wrap it up there, but Jimmy, thanks as always for your input. Always appreciated.
Thank you.
Jimmy Jean is Vice President, Strategist, and Chief Economist at the Desjardins Group.